What if October 2025 became the month your wallet felt lighter without you even realizing why? Across Britain, a wave of new laws, taxes, and price shifts is quietly rolling in, touching everything from your morning commute to your weekly grocery bill. Energy prices, packaging costs, housing rules, and even the way your investments are taxed are all changing at once. These aren't distant policy tweaks, they're decisions that could shape how much you spend, save, and earn every single day. The question isn't whether these changes will affect you, it's how deeply they'll reach into your everyday life. Number 1. Energy price cap increase. From October 2025, households across Britain will feel the impact of the new energy price cap rise, with average annual bills expected to climb by about £35. The Office of Gas and Electricity Markets, Ofgem, has confirmed that this adjustment reflects higher wholesale energy costs and updated regulatory allowances for suppliers. Although the increase might sound modest, its ripple effect is far wider, influencing not only home heating but also the price of goods and services that depend on electricity and fuel. Many families already stretched by inflation will need to rethink how they use energy day to day. Turning off unused appliances, switching to fixed-rate plans, and reviewing home insulation could all become essential strategies to manage these costs effectively. Energy suppliers are also being urged to expand support programs for low-income customers who may find the seasonal jump especially difficult. The rise is tied to global shifts in gas markets, geopolitical instability, and the UK's ongoing transition toward renewable power sources. These transitions, while crucial for sustainability, involve expensive infrastructure investments, costs that are now filtering through to consumers. Analysts suggest that the higher price cap may be a short-term measure, but any further turbulence in global supply chains could push bills up again in early 2026. The government continues to promote heat pump installations, solar incentives, and smart meter upgrades as part of a longer-term plan to stabilize costs and reduce reliance on imported fossil fuels. For many homeowners, the challenge will be balancing immediate budget pressures with the opportunity to adopt cleaner technologies that might offer savings in future years. Beyond the household level, the energy price cap adjustment has implications for small businesses, public services, and even local councils. Cafes, retailers, and community centres that depend on consistent heating and lighting will likely face higher running expenses, forcing some to raise prices or cut operational hours. Economists warn that this could subtly feed back into overall inflation, affecting food and transport costs. Consumers may not notice the full effect overnight, but as winter sets in, every thermostat adjustment will carry a heavier financial weight. The energy market's volatility highlights a crucial reality. Britain's economic resilience is now tightly interwoven with its energy policy, and the October 2025 cap marks another reminder that energy security and affordability remain central to every household's financial stability. Number 2. Packaging and Extended Producer Responsibility (EPR) tax. October 2025 marks the start of the new Packaging and Extended Producer Responsibility (EPR) tax, a policy set to reshape how products are packaged, priced, and ultimately paid for. Under this scheme, companies will bear the financial burden of collecting, recycling, and disposing of packaging materials they put on the market. The idea is simple. Those who produce waste should pay for managing it. Yet, the practical effect is that many firms are expected to pass these costs directly to consumers. Everyday items, from snacks and bottled drinks to cleaning products, could rise in price as businesses adjust to meet the new environmental standards. Shoppers may soon notice subtle design changes on shelves, such as thinner wrapping, recycled materials, or fewer multi-buy plastic bundles, as brands scramble to minimize their tax exposure while maintaining product appeal. The EPR system reflects the government's push toward a circular economy, where materials are reused and waste is minimized. It builds on earlier policies like the plastic packaging tax, but goes further by targeting all packaging types, including cardboard, glass, and metal. Environmental campaigners have long argued that shifting responsibility from consumers to producers is essential for meaningful waste reduction. However, trade associations warn that the policy's implementation costs could reach billions, placing small and medium-sized enterprises under significant strain. Supermarkets and major suppliers are exploring new partnerships with recycling firms and packaging innovators to soften the financial blow. Some businesses may even highlight their compliance efforts as part of marketing campaigns, hoping to appeal to environmentally conscious buyers who value sustainability over short-term savings. For households, this change will be felt not only through higher product prices, but also through adjustments in recycling routines. Councils are preparing for new labeling systems designed to simplify sorting, while waste collection schedules may be updated to handle different material streams. Consumers will likely face more reminders about recycling accuracy and fines for contamination in recycling bins. The long-term goal is to create a cleaner, greener production cycle, but in the short run, the average shopper's wallet will absorb the transition costs. While it may seem like a small policy shift, the EPR tax will quietly influence everything from grocery bills to supply chain logistics, making it one of the most far-reaching changes arriving in October 2025. Number 3. Capital Gains Tax, CGT, rate hikes. From October 2025, the UK government will roll out higher capital gains tax, CGT rates, raising the basic rate from 10% to 18%, and the higher rate from 20% to 24% for non-residential assets. This marks one of the most significant tax adjustments in recent years, aimed at narrowing the gap between earnings from work and earnings from investments. For investors, landlords, and small business owners, the impact could be immediate. Anyone planning to sell property, shares, or other valuable assets after October will face steeper tax bills on their profits. Financial advisors are already warning clients to reconsider the timing of their disposals, as those who act before the deadline might secure considerable savings. The government argues that the change promotes fairness by ensuring that wealth growth through investments contributes more equitably to the public purse. The rationale behind the rate hike lies in the ongoing debate about wealth distribution and public funding needs. With the state seeking to reduce its borrowing levels and fund social services, higher CGT is seen as a politically safer move than raising income tax or VAT. Critics, however, caution that this could discourage entrepreneurship and investment, as business owners might hesitate to sell or reinvest due to the heavier tax burden. Economists also note that such adjustments can alter behavior in subtle ways. Investors may hold on to assets longer or move funds into tax-sheltered vehicles like ISAs or pensions. This shift could slow liquidity in the property and stock markets, potentially cooling short-term economic activity. Meanwhile, accountants expect a surge in demand for tax planning advice as individuals look for legitimate ways to mitigate the increase. For the average household, the capital gains tax change may seem distant, yet its effects often trickle down. Property investors might raise rents to offset their future liabilities, and companies may pass on higher compliance costs through price increases. The reform also highlights the growing focus on fiscal transparency, with authorities improving digital reporting systems to track asset sales more efficiently. Over time, this tighter tax regime could redefine how Britons approach wealth building, prompting a move toward longer-term financial strategies rather than quick profit-taking. The October 2025 CGT hikes signal a decisive shift toward balancing fairness and fiscal responsibility, but they also serve as a reminder that every financial gain now carries a higher cost to keep the nation's books balanced. Number 4. Stamp duty and share transaction changes. October 2025 brings a notable update to stamp duty and share transaction rules, a reform designed to stimulate investment while maintaining government revenue streams. Under the new plan, newly listed company shares on the London Stock Exchange will be exempt from the 0.5% stamp duty that previously applied to all share purchases. The exemption aims to make the UK market more attractive for both domestic and international investors, especially at a time when global competition for new listings is intense. By easing the initial tax burden, the Treasury hopes to encourage more firms to float publicly, creating new opportunities for traders and potentially revitalising the City of London's financial standing. This policy change has been welcomed by many in the business community who view it as a necessary boost for capital markets following several years of uncertainty and reduced IPO activity. However, the reform comes with a complex ripple effect. While newly listed shares will gain relief, existing and secondary share transactions will still carry the same 0.5% duty, maintaining a consistent source of tax revenue from ongoing market activity. Analysts predict that larger institutions may restructure their investment portfolios to take advantage of the exemption, while retail investors could see greater volatility as new listings become more frequent. The change also reflects a subtle shift in economic strategy, one that prioritizes stimulating business growth over short-term tax collection. Yet, critics argue that the benefits may be uneven, favoring large corporations and financial institutions more than the average investor. Some also question whether the lost revenue from the exemption could eventually be recouped through higher fees or adjusted taxes elsewhere in the financial system. For individuals engaged in TIS, trading or investment, these stamp duty adjustments will reshape how portfolios are built and diversified. Those investing in newly floated companies might find themselves saving modest amounts on transaction costs, while long-term investors holding established stocks will see little direct change. The broader implication lies in what this signals about the UK's fiscal direction, an effort to modernize its markets, attract capital, and restore investor confidence after a period of economic turbulence. Financial experts suggest that if successful, the reform could draw new life into pension funds, equity investments, and broader wealth creation. Yet, for the average citizen, its impact may remain subtle but persistent, influencing savings growth and the overall climate of opportunity within Britain's investment landscape. Number 5. Business rates and retail tax pressure. As October 2025 arrives, business rates and retail taxes across Britain are undergoing one of the most consequential shifts in years. The new rate revaluation introduces higher charges for large retail spaces, logistics hubs, and hospitality venues. The government's rationale is to ensure that major corporations, especially supermarket chains and multinational retailers, contribute a fairer share to public revenue. However, the practical reality is that these added costs often cascade down the supply chain, ultimately reaching consumers through price increases on everyday goods. Analysts estimate that retail prices could rise between 1% and 3% over the next quarter as companies adjust to the higher overheads. For smaller businesses, particularly those already grappling with rent and wage pressures, the revaluation poses additional strain that could force difficult choices, either raising prices or scaling back operations to stay afloat. The new business rates system also reflects a wider attempt to modernize Britain's commercial property taxation model. Under the previous system, many physical retailers were paying disproportionately more than online competitors. The updated scheme seeks to partially address this imbalance by revising how online distribution centers are valued, ensuring digital retailers also shoulder a greater portion of the tax burden. While this adjustment promotes fairness in theory, its rollout has been criticized for lacking adequate transition support. Many small independent stores are struggling to adapt to the recalculated valuations and new digital filing requirements. Economists warn that this could accelerate the decline of high street shops, especially in towns where consumer spending remains fragile. Retail associations have urged local councils to use part of the additional revenue for urban renewal projects that could draw shoppers back to physical stores. For consumers, the business rates increase will likely appear as small, steady price rises rather than abrupt jumps. Essentials such as food, clothing, and household items may edge higher as retailers attempt to maintain profit margins. Over time, this could subtly influence shopping habits, driving more people toward discount chains or online platforms offering lower prices. The government contends that the new model supports a more sustainable fiscal system and helps finance community services, yet its timing, amid inflationary pressures, could make everyday budgeting harder for millions. The October 2025 adjustment illustrates how tax policies targeting corporations can quietly reshape spending patterns, employment stability, and the overall rhythm of Britain's retail economy, one purchase at a time. Number 6. Driving, transport charges, and regulation changes. October 2025 introduces a fresh wave of driving and transport reforms that will influence nearly every motorist in Britain. Several cities, including Oxford, Bristol, and parts of London, are expanding their daily toll zones, with charges ranging from £5 to £15 depending on vehicle type and emissions rating. These fees are part of local initiatives to curb congestion and improve air quality, aligning with broader environmental goals under the government's net zero commitments. Alongside these tolls, electric vehicle (EV) charging costs are set to increase following adjustments in energy tariffs and maintenance levies for public charging points. Although EVs remain cheaper to run than petrol cars, the gap is narrowing, prompting many drivers to reconsider the overall savings. Fuel prices, while fluctuating, are also expected to inch higher as global supply concerns and refinery taxes continue to affect the UK's fuel market. Beyond the direct costs of driving, transport policy updates are reshaping how citizens commute. The ultra-low emission zone (ULEZ) boundaries in major cities are expanding, affecting more vehicles and potentially adding daily costs for older petrol and diesel cars. Additionally, new MOT testing standards will take effect, requiring stricter checks on emissions and safety components. This move aims to enhance vehicle efficiency but may lead to higher repair expenses for older models. Public transport is also experiencing its own adjustments, with rail fares expected to rise by around 4% to match inflation. For commuters, that means travel cards, fuel, and maintenance together could claim a larger portion of monthly income. The changes reflect an evolving national strategy, one that prioritizes cleaner air and infrastructure investment, but also places new financial responsibilities on the everyday traveler. For households, the combined effect of these transport-related increases will feel like a gradual tightening of mobility budgets. Those living in suburban or rural areas where public transport options are limited could be hit hardest as driving remains essential for work and family commitments. Businesses reliant on logistics and delivery services will likely raise shipping fees to offset higher transport costs, subtly pushing consumer prices upward once again. While policymakers emphasize the environmental and health benefits of these reforms, the economic reality is that moving around Britain is becoming more expensive. October 2025 marks a turning point where sustainable transport policy collides with household affordability, making every journey, from school runs to cross-country deliveries, a more calculated financial decision. Number 7. Product Regulation and Metrology. Act 2025. October 2025 marks the full enforcement of the Product Regulation and Metrology Act 2025, a sweeping law designed to reshape how goods are manufactured, labelled, and sold across Britain. The Act consolidates dozens of older consumer safety and measurement rules into a single, modernised framework. It gives regulators greater authority to set standards for packaging, weights, and product composition, ensuring consistency and transparency across industries. Businesses will now be required to provide clearer labelling on the origin, quantity, and environmental impact of their goods, while also complying with updated digital traceability requirements. For consumers, this means products on supermarket shelves will appear more standardized, with easier-to-read information about quality and sustainability. Yet, compliance costs for producers are expected to rise, and experts predict these costs will ultimately be reflected in higher retail prices for everyday items. The metrology section of the Act deals specifically with measurement accuracy and product claims. Everything from the weight of packaged foods to the performance of home appliances must now meet stricter verification standards. Trading standards officers will gain expanded powers to inspect factories, audit data, and fine companies for misleading measurements or false advertising. While this increased scrutiny promises better consumer protection, small and medium-sized manufacturers are warning of significant administrative burdens. Many will need to update machinery, retrain staff, and adopt digital certification systems to stay compliant. Environmental groups have welcomed the law as a milestone for sustainable commerce, noting that it encourages efficiency, reduces waste, and discourages greenwashing. However, industry associations caution that rapid implementation could disrupt supply chains already stretched by energy and logistics costs, potentially delaying product releases and inflating operational expenses. For ordinary shoppers, the impact of the act will unfold gradually but noticeably. Some familiar brands may repackage their products with reduced volumes to meet new efficiency standards, while others could introduce eco-certified versions that carry a premium price tag. Electronic goods may feature new digital QR codes linking to real-time compliance data, offering transparency, but also hinting at how deeply technology is becoming woven into consumer regulation. Over time, this law is expected to reshape market behavior, rewarding companies that invest in quality and sustainability while penalizing those relying on outdated manufacturing models. The Product Regulation and Metrology Act 2025 thus represents a significant pivot toward accountability, fairness, and precision. Yet for every household, it also means another quiet shift that touches the price and quality of nearly everything they buy. Number 8. Tax regime changes for non-UK domiciled residents. From October 2025, a major overhaul of Britain's non-dom tax system will come into effect, replacing the long-standing remittance basis with a new framework known as the arriver regime. This system grants new UK residents a 4-year period of partial tax relief before they are taxed on worldwide income. The change is designed to simplify the tax code, close loopholes, and ensure that individuals who live and work in the UK contribute more equitably to public finances. For decades, wealthy foreign residents could shelter overseas earnings from UK tax under the non-dom rules, often leading to accusations of inequality. The new arrangement aims to modernize residency taxation and create a fairer balance between attracting global talent and maintaining revenue integrity. While the government insists that Britain will remain competitive, many tax experts expect some high-net-worth individuals to reconsider their long-term residence plans, particularly those who relied heavily on offshore structures. The financial implications of this reform stretch far beyond London's elite circles. Accountancy firms anticipate significant movement of capital as families restructure their investments to comply with the updated rules. Some may accelerate property purchases or transfers before the change takes full effect, while others could explore alternative jurisdictions within Europe or the Middle East. The Treasury estimates that this shift will generate billions in additional tax revenue over the next decade, money that could support social programs and public services. However, critics warn that it may also dampen the attractiveness of the UK as a global financial hub. The transition will demand careful navigation, with stricter reporting standards and increased scrutiny on foreign income and asset declarations. Tax advisors are urging clients to prepare early, emphasizing compliance and transparency as key priorities under the new regime. For the broader population, the revised non-dom system symbolizes a cultural and economic turning point. It signals an effort to align the country's tax structure with modern expectations of fairness, especially after years of political debate over wealth inequality. Though most citizens will not be directly affected, the consequences could ripple through sectors such as real estate, finance, and luxury goods. A potential slowdown in high-value property investment might ease housing demand slightly in certain regions, while reduced offshore inflows could temper parts of the financial market. Ultimately, the October 2025 reforms aim to strengthen Britain's fiscal credibility, ensuring that residency brings not just opportunity but also shared responsibility within the nation's evolving economic framework. Number 9. Transfer pricing and international tax compliance reforms. Starting in October 2025, the UK will implement new transfer pricing and international tax compliance reforms, marking a decisive step toward aligning national policy with global standards set by the Organisation for Economic Cooperation and Development, OECD. These rules will require multinational companies to provide more detailed documentation on how they allocate profits across borders, ensuring that tax is paid where real economic activity occurs. The changes will also close existing loopholes that allowed some corporations to shift profits artificially between subsidiaries in different countries. For the first time, even certain UK-to-UK transactions will fall under stricter transfer pricing oversight, meaning domestic branches of large groups must justify internal pricing structures to tax authorities. Revenue and Customs, HMRC, expects this shift to enhance transparency, prevent profit shifting, and reclaim billions in lost revenue each year. The documentation requirements under the new system are significantly more demanding than before. Businesses will need to maintain 3 distinct reports: a master file outlining global operations, a local file detailing UK-specific transactions, and a country-by-country report showing tax paid in every jurisdiction. These updates follow years of consultation aimed at modernising the UK's corporate tax framework. Supporters argue that the rules will create a level playing field, reducing the advantage held by corporations that use aggressive tax planning. However, critics contend that compliance costs will rise sharply, especially for medium-sized enterprises that operate internationally but lack the administrative infrastructure of global conglomerates. Many firms are investing in tax technology systems and training staff to meet the new standards, recognizing that penalties for non-compliance could be severe. Some experts believe this will drive a cultural shift within corporate finance departments, where tax governance becomes as critical as financial reporting. For the average citizen, the transfer pricing reforms may sound remote, yet they could influence the broader economy in meaningful ways. If successful, the policy will help stabilize public finances and reduce the need for future tax hikes that affect ordinary households. Greater transparency may also restore public confidence in how multinational profits are taxed, reinforcing the idea that large companies should contribute fairly to the communities they operate in. Still, there are concerns that corporations facing higher tax bills could adjust prices or reduce local investments to offset costs. The October 2025 reforms thus represent both an ethical and economic milestone, one that could redefine how Britain manages corporate accountability, fairness, and fiscal sustainability in a rapidly globalizing world. Number 10. Planning, Infrastructure and Housing Reform. October 2025 will see the rollout of sweeping planning and housing reforms that could reshape Britain's property market for years to come. The government's new framework aims to accelerate housing development, simplify planning approvals, and introduce a national property tax that may eventually replace traditional stamp duty for homes above specific value thresholds. These reforms are intended to address chronic housing shortages while ensuring that the taxation of property ownership reflects real market value rather than outdated valuations. By streamlining local planning permissions and expanding infrastructure investment zones, policymakers hope to unlock thousands of stalled housing projects across England and Wales. However, industry experts warn that implementing these reforms could initially create uncertainty in the market, as developers, estate agents, and buyers adapt to new tax structures and approval processes. Home buyers, in particular, may face temporary price fluctuations as the system transitions from upfront transaction taxes to an annualized property levy. The planning overhaul also introduces stronger incentives for sustainable construction and energy-efficient design. New homes built under the post-2025 framework must meet enhanced insulation and low-carbon heating standards, part of the broader national drive toward net zero emissions. Local councils will receive additional powers to negotiate developer contributions for green infrastructure such as cycle paths, renewable grids, and flood protection. While these environmental goals are widely supported, the added compliance requirements are expected to push up construction costs, at least in the short term. This could make new builds more expensive for buyers until supply catches up with demand. For renters, the shift may manifest through raised rents as landlords absorb new energy and building regulations. Despite these transitional pressures, policymakers argue that the reforms will ultimately create a more transparent, efficient, and environmentally responsible housing market. For households across Britain, the housing reform package represents both opportunity and risk. First-time buyers might benefit from faster planning approvals and a potential reduction in upfront taxes, while long-term homeowners could face higher annual property charges. Regions outside London and the South East may experience a boost in development as red tape is reduced, potentially stimulating local economies. Yet, economists caution that these benefits depend on consistent implementation and cooperation between central and local authorities. The October 2025 reforms signal a new chapter in the nation's approach to land use, urban growth, and fiscal fairness. An effort to balance affordability, sustainability, and economic dynamism in one of Britain's most critical and politically sensitive sectors, October 2025 stands as a turning point for households, workers, and businesses across Britain. From the rising energy price cap and new packaging taxes to changes in property rules and corporate tax reforms, every part of the economy is shifting under new financial pressures. These updates are not isolated, they're interconnected forces that shape how much it costs to live, move, and plan for the future. For families already juggling expenses, even minor adjustments in utility bills or supermarket prices can make a noticeable difference. For businesses, the changes redefine how they operate, compete, and invest in a landscape that demands both compliance and innovation. Yet amid the uncertainty, these transformations also present opportunity. A smarter approach to budgeting, greener consumption choices, and better financial awareness can help turn challenge into advantage. Understanding how each policy affects your daily life is the first step toward resilience. Whether you're a homeowner preparing for new tax rules, a driver adapting to transport fees, or simply someone managing monthly expenses, being informed puts you one step ahead. Britain's economy is evolving rapidly, and awareness is your strongest defense against rising costs. If you found this breakdown useful, hit the like button and subscribe for more updates that keep you financially prepared. Share this video with friends or family who need to understand how these October 2025 changes might affect them. Drop a comment below. Which change do you think will hit your wallet the hardest? Let's talk about it.